Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, welcome back to the show.
Jim, it's a pleasure to be on the show. Today we're going to talk about what implications there are of the fusion breakthrough announced this week, the very immediate implications of the new life exemption for raising money by juniors, and we're going to talk about the results of Arctic Star and its Diagras diamond project.
John, does the fusion breakthrough announced this week have any implications for the mining sector?
This fusion breakthrough has long-term implications for the mining sector, but no immediate implications. On Tuesday, the National Ignition Facility at the Lawrence Livermore Laboratory, which is about 30 minutes from where I live, it made an announcement that they had achieved a 3 megajoule output from a 2 megajoule input using their laser technology that they developed in 2009 and have been using mainly to test nuclear explosions for weapons of mass destruction at extremely tiny scale so that they no longer have to do underground explosions such as they used to do. When they created this, they also said, we would like to do fusion research, but they have been somewhat of a joke since 2009 and have not made much progress. Other research institutes have used the tokamak as the basis for their fusion research, and the tokamak is a magnetic bottle that contains the hydrogen fuel pellets, and they raise it to extreme temperatures. But the tokamak method has not yet achieved this gain. And the idea is that you want to get more energy out than you put into the process. And they announced that on December 5th, they finally made this accomplishment. Now, it doesn't mean that we're going to have fusion energy tomorrow, but it is a milestone that has never been achieved before. And the biggest implication is that it now gives serious hope for the younger generations, the Gen Zs and the millennials, that by 2040, 50, when one could expect this to be commercialized to a scale to make large-scale fusion-based electricity, it gives them hope that there is a future after the boomers leave the planet in 2040, a future that will very likely involve a massive reduction of energy costs. And that is the really important thing about fusion, that because it is something of a perpetual motion machine, that if you can get it going and it does not have these hideous radioactivity containment costs that nuclear fission power has, it is possible that we may see a 90% or more reduction in the cost of energy. And that has big implications, especially for the mining sector. We've heard of peak oil, and that sort of went away in the past decade when fracking was developed, which allowed them to tap the sticky oil that's in these shale oil formations and extended the supply of oil as a fossil fuel. But the peak oil concept is based on the fact that a long time ago, plankton or vegetable matter settled in these basins, ended up getting buried, cooked into oil. And these are finite resources that were formed long ago, and when we find them and deplete them, they are just gone. Now, peak metals is a different concept. With peak metals, people fret about there's not going to be enough copper, there's not going to be enough nickel for a world that keeps growing. This year we hit 8 billion people. Unless we have some catastrophe, that population will keep growing. And of course, this population wants to have a higher standard of living. In order to sustain this growing population and improve the overall standard of living, we need a massive energy drop. And what this will do is it will facilitate the mining and extractions of deposits with grades that are well below what is counted as economic grade today. For example, if you want to do an open pit copper mine, you need at least 0.3% copper. You want to do underground copper, you need at least 0.6%. And the energy costs are not going down. The energy transition, in fact, will likely increase energy costs. So with mining and extraction of metals, energy is a major cost. So with energy costs fixed or rising, you cannot improve the economic grade, lower the economic grade of a deposit. So everything that works at today's metal prices, it is being mined and depleted and fabricated into something else. But as we deplete these resources, all of a sudden we're stuck with like 0.1%, 0.2% copper deposits. Well, in the long run, the price of the copper could go up higher in real terms, so that would allow a lower cutoff grade to be used, and we could continue to supply the metal. But that is not really going to improve the prosperity of the world in any way. It will simply sustain the supply of basic materials that it needs. If we end up with an energy cost reduction of, say, 90% or more, such as what the oil did when it was developed and transportation suddenly became much more efficient than it used to be, then you will be able to tap all these zones of mineralization that are out there. And unlike oil, which will have accumulated in these pockets and are waiting there to be found and a straw stuck in and sucked dry, mineral deposits formed through hydrothermal activity or other magmatic processes that move fluids through vast volumes of rock, picking up various amounts of metals, and then dropping it out in various degrees in the right sort of temperature, pressure, and chemical receptivity conditions. And that forms your whole range of very high-grade, large deposits to very sort of low-grade, large, dispersed deposits. And these sub-economic deposits, the juniors are fantastic at finding them. They've documented them. And, of course, the whole aluminum model during the supercycle revolution, China supercycle in the 2000s, that was all based on these deposits that didn't quite make the grade when they were found in the 70s and 80s. But suddenly when you had a real price increase in the metal caused by China coming on stream and making it all possible by creating deflation in the cost of everything, those suddenly were in the money, were acquired by various companies, and many of them are in the pipeline to be developed or have already developed. The next revolution is not going to be because of a higher real price for the metals. It's going to be because of the dropping of the cost of extracting the copper and other minerals from their ores. And this is especially going to be interesting for critical metals, which are often tied up in complex mineralogies, which require a lot of acid and heat to crack out of their cases and make available to be used in all sorts of new materials. And part of this, the exciting thing about the fusion breakthrough is it sets the stage for almost a Manhattan Project type mentality. Now, the Manhattan Project unfolded over a 3-year period. This is going to unfold over 15 years. But the implication of this is not like creating a weapon of mass destruction. This is preparing humanity for the next leg in prosperity, growth, and for reversing the consequences of climate change from fossil fuel combustion. I mean, even if we achieve our 1.5 degree maximum gain by 2040, 50, you're still going to have a problem with climate will have changed in ways that are very harmful. And one of the harmful ways that the climate will change the world is in water supply. And water supply, it's being depleted as human population grows. But the irrigation is also harming it. And when you, for example, in California, Southern California, as you suck up water from the aquifers, it pulls in seawater. So you end up with all these fertile fields being, suddenly becoming salty and no longer that fertile. And of course, with climate change, you get these changing weather patterns. So areas that used to get plenty of rainfall that would irrigate the fields and also snowpacks in mountains, which would hang around and store the water for a while so it could be gradually delivered. Climate change is going to alter all these patterns. So we have a huge disruption of freshwater supplies coming. And the primary solution for this is not getting rid of almonds, big water-sucking crop, or banning lawns or anything like that. It is desalination. And desalination is basically evaporating seawater, dropping out all the salts and stuff that are in there, and put them on a barge, dump them back into the middle of the ocean, and condensing the steam and create basically pure, fresh water. And the Saudis do it right now with their surplus oil because they've got a desert and they have a freshwater problem. But it's not really feasible at the current cost of energy. But if fusion becomes a reality and its cost of electricity drops 90% or more, desalination becomes a major solution to the world's future water problem. And this is something similar, it's parallel to what I'm talking about with the end of peak metals, in that if we get this massive energy cost reduction, an abundance of minerals and metals become available for extraction and usage by mankind, and facilitate another major step up in terms of human prosperity. And I think the main significance of this development is that for the younger generations, there's now reason to hope for what's in 2040 and beyond, when we have everything electrified with electric cars, but we still have an expensive electricity grid. All of a sudden, then we get a major step down in energy costs that makes all kinds of things possible. In terms of mining deuterium and tritium, which are the key inputs for fusion energy, they are not the same thing as uranium for nuclear fission energy. Deuterium is a hydrogen atom that has one neutron, and all the deuterium that exists was created during the Big Bang. It does get manufactured inside stars, but it gets rechanged into something else. So there is no new deuterium being produced, and it's a very stable isotope, but there's only one deuterium atom for every 6,400 normal hydrogen atoms. So they have to recover this from distilling seawater and slowly stripping out what they call the heavy water and using that in the fusion process. And tritium, that's a proton, a hydrogen proton with two neutrons. That's an extremely stable isotope. And this might still be a use for old fission type of facilities, because it ends up being created when you in nuclear power plants, when lithium ends up being irradiated. It's a byproduct of that process. And the reason they need deuterium and tritium in human designed nuclear fusion is these two create the extra neutron that's spat out when you combine deuterium and tritium to fuse it into helium, which is stable with two neutrons and two protons. So it's this expelling of the neutrons that is the energy that then has to be harvested. In terms of practical issues and making this all commercial, one of the problems with the National Ignition Facility announcement is that even though they had an energy gain, they actually sucked 300 megajoules out of the electric grid to prime these 192 lasers that blasted this pellet and fused it into helium. And that's obviously not feasible. Plus, this facility occupies several football fields. You would need something with a much bigger output, 30 to 100 times energy gain, a much smaller footprint. And again, this is going to be a real sort of push for the materials research, material science research. The ceramics behind the lasers, after doing that 1/100th of a trillionth of a second pulse, takes 7 hours to cool down in order to do another pulse. So this is why this is not a wonderful thing for next year, but it is something for 15 years from now, and requires an enormous amount of research, put into this. And of course, as quantum computing comes in and helps solve some of these problems with much greater efficiency, this is a very positive development, which I think should give people a boost in their outlook for their long-term future.
What are the implications of the new Listed Issuer Financing Exemption? Does it promise life for juniors?
The Listed Issuer Financing Exemption, or LIFE as they call it for short, has been embedded in the National Instrument 45-1064 Prospectus Exemptions, which is the big umbrella term for doing financings that don't involve a prospectus and that are like a short offering memorandum, which is where you do it and the stock created is immediately free trading. Private placements is what we normally call these financings. And in the 80s, the retail investors used to have their accounts at regular brokers, and we had something called a statement of material facts, where you would do a financing that would be immediately free trading. It was open to anybody who had money in their account, and retail was able to fund the juniors as much as it wanted to. That began to change in the 90s when discount brokers emerged, and the industry shifted to private placements. And the exemption for private placements was you either had to be a friend of management, or you had to be a member of the brokerage industry, so a little club, or you had to be worth $1 million, have a net worth of $1 million. Initially, they allowed you to include the net equity in your primary residence, but then they eliminated that and said you have to be a minimum worth $1 million, excluding whatever equity you have in your primary residence. And only these people were allowed to participate in private placements. And private placements absolutely dominate the funding mechanisms for resource juniors. And I have the data going back to 2000 demonstrating to what extent private placements are the mechanisms. Now, short offering memorandums are theoretically open to retail investors, but retail investors are not what the brokerage industry, the full service brokerage industry, is after these days. They have gone from being commission-generating traders for their clients to asset gatherers. And when a brokerage firm says, okay, we're going to do, $30 million bought deal at 60 cents, they spread it around to clients who are basically high net worth investors. So all these retail investors, they're all out there dispersed using discount brokers. They never talk to a human being for advice about anything and do not have access, a gateway to financing. Now, during the past decade, the regulators came up with something called the existing shareholder exemption, and you were allowed to do up to like $25,000 per company per year, even if you weren't a millionaire. But when the company announced the financing, if you weren't already an existing shareholder, well, even if you checked it out and said, wow, this is great, I'd love to do this financing with the full warrant unit, I like the story. Sorry, you don't already own the stock. And it also became a verification nightmare for the company. So this attempted solution was dead on arrival, never went anywhere. But I've given presentations at PDAC on several occasions, technical presentations, arguing that the Canadian resource junior ecosystem, it's going to die if we do not enable retail investors to put their money directly into the treasuries rather than just from the accredited investors, the millionaire pool. And the problem that has happened is that the more efficient, promotional, better managed companies, they've ended up identifying who all the millionaires are out there who are interested in the resource sector. So they kind of have them as a captive audience. And that leaves the majority of resource juniors having to try and find funding through ways that aren't really possible. Ideally, a company does a good job with its website, with its presentation, just how it articulates its story, All of this is available now thanks to the internet to an open-ended retail audience. So the audience should be able to find the junior. And when the junior announces a financing, anybody there should be able to participate. And the regulators realize that, Canada is rivaled only by Australia in terms of resource exploration culture, but the Canadian system was losing its financing edge. The Australians do not have the same restrictions as the Canadian system, so they went back to the drawing board, and on November 21st, I believe it was, they finally made it official. So what the rules now say is that a company, so long as it's been around for at least 12 months and is up to date with all its regulatory filings, it can do up to $5 million financing, or if it's up to 10% of their market cap to a maximum of $10 million. So it's kind of a $5 million to $10 million limit. They don't want to replace the larger financings that are still being done with accredited investors. And so far, it's been mainly brokerage firms who are doing this. They obviously have the clients in place, so they can place this immediately free trading paper without all the complexity of a short offering memorandum. The company only has to file a document on CDAR explaining the basics of the company and the terms of the financing. But several juniors are now attempting the non-brokered versions. And it's going to be a bit complicated because, collecting $10,000, $5,000 checks is different from collecting a $150,000 check. So this is going to have its teething problems as they figure out how to do this. What I think ideally should happen is somebody should create some sort of clearinghouse system where retail investors register, provide all the evidence. I live in Saskatchewan or British Columbia, establish what jurisdiction that you would be meet whatever for which the financing has been made available, and then put in all the details about where, when the digital certificates end up in your account there, where do they go to which discount broker account, and so on. Make this all a digital, seamless process in terms of these documents, these ridiculous 50-page documents that right now credit investors have to trudge through and find a half dozen boxes spread among 60 pages that they need to tick off. Streamline all this, make the documents online, have a bunch of boxes that you need to check online, and then set up the transfer of the money with the smaller amounts, maybe a series of e-transfers from banks for the Canadian residents. All of this is going to come together next year. It's really important that they've done that. And why did they finally come around to doing this, to opening up this huge pool of retail investor capital? Well, the reasons for restricting it to millionaires were profoundly dumb and elitist. They assumed that anybody who wasn't a millionaire did not have the smarts to assess the risks of a private placement. And they also had this patronizing attitude that, if you weren't a millionaire, you can't afford to risk losing money on whatever. But this made no sense because your retail investor could use his discount brokerage account, read a bunch of crap on Reddit where some pump and dump operations underway, and blow their brains out buying the stock in the open market that's being sold by the millionaires who did the private placement, who are clipping the free lunch warrant and blowing the long position into the hands of the retail investors. There was nothing being accomplished by having this restriction. Plus, the foolishness of this restriction. If you're making $250,000 household income for the past 2 years because you're a doctor, what special knowledge do you have about the risks of investing in a resource juniors? You really don't. What if you're a trust fund baby who spends his time snorting coke and working for an NGO? What do you know about investing in a resource junior? So So, and if you're a real estate developer worth a huge amount of money, what do you know about the risks of investing in a resource junior? The other thing they observed is, and we can probably thank Bitcoin for this, is all these Gen Z and millennials, they piled into Bitcoin, totally unregulated. They ran up with the momentum train, and a lot of them probably bought too high and have now lost their shirts. But there's no rules restricting individuals from blowing themselves up buying crypto. So buying crypto does nothing except enrich some ideologue yapping about fake freedom and so on, and Chinese and Iranian and North Korean cyber thieves and criminals laundering their money. Whereas if you're putting your money into a resource junior directly, and it's a large group of them, even if this one ends up a dud, it's the collective action of all these juniors, legitimate juniors, doing this exploration activity, which results in the creation of new mineral wealth that can benefit future generations. So why restrict retail investors from putting money directly through private placements into these juniors? Well, they've finally gotten over this and realized this makes a lot of sense. And in the context of Ottawa saying, we have an abundance of critical minerals, we actually care about the energy transition that's underway, and we want to support the mineral mining sector. And again, if you're going to restrict it to that tiny percentage of Canadians who are millionaires to fund all this, that makes no sense. So this makes huge sense to open up private placement financing, immediately free trading. There's going to be some interesting dynamics associated with this, but you now allow retail investors to put money in for these obscure toiling geologist stocks, get a warrant if it comes with it, and play the game on the same terms as all the millionaires. I think this will be a major benefit in enabling the Canadian resource junior ecosystem to survive.
What did you think of the Sequoia micro diamond results reported by Arctic Star?
Well, I thought a lot more of them than the market did. When the results came out, the market pounded the stock down to a couple pennies, where it is now limping. Now, the news came out on December 5th, and it involved the results of 6 holes drilled into the Sequoia kimberlite that they had found last year in 2021. And this had yielded a microdiamond curve. It wasn't going to be a high-grade Diagras type pipe, but it was going to be something in the 20 to maybe 60 CPHT range. And the story was, well, this is not going to be a standalone operation. Diagras project is all about finding something that De Beers overlooked or simply dismissed as not big enough during the late 90s when it held the Hardy Lake block, which is now called Diagras and owned 81.5% by Arctic Star. All we need to do is find something here that can be fed into either the Diavik or Ekati mining operations, which are nearby, both of which probably face depletion in 10 years and big reclamation liabilities. So we're not trying to find a $2 billion home run. We're trying to find something that ends up being worth, maybe a couple $100 million. So they went in there again in May, drilled these extra 6 holes. They were drilled about 100 meters apart from two drill pads. 2 holes went vertical, and then from each pad there was one that fanned east and one that fanned west. And they published a composite of these results. And when I plotted them up, well, it was the curve. The slope did not change, but the overall curve dropped lower, so that instead of hoping for something in the 40 to 60 CPHT range, you had to think in terms of, okay, it's probably 20 to 30 CPHT range. But the market understood. It wanted bigger and better, and instead it got slightly lesser, even though the original story was still largely intact. Now, the Sequoia complex, the gravity anomaly, it's about 500 meters long. It has another 300-meter fainter tail to the south where the jack pine kimberlite was found in the early 2000s and tested by Magiscore. Its microdiamond curve from 763 kilograms, it just tanks. It's got zero macro grade potential. But the Sequoia complex itself was not recognized by De Beers. It was not part of the initial 24 pipes that it found largely on the basis of magnetic anomalies. And I've talked to Pat Power, and he says, well, not all of these holes had the same normalized microdiamond counts in the different sieve classes. So when talking to Buddy Doyle, he says, I think what we're dealing here is a structural trend along which there is a multiple of eruptive phases that happened over different periods of time. And some of them could be quite high grade, some of them low grade, and some possibly like jack pine, no grade at all. And this can happen because these kimberlite magmas, they evolve in the mantle, work their way into the lithosphere, sample parts of the diamond stability field, and it really depends on what they encounter on their path to the surface. Eventually, they get channeled along these structural zones of weakness, which is why you can have a bunch of kimberlite pipes next to each other, all of different chemistry and different, diamond populations. So what you really need to do in a case like this is you need to properly delineate the system. And they have enough encouragement to justify doing that. Buddy would like to go back in there in ideally in late January when they can use the winter road to get up there and properly delineate the Sequoia complex to see where these different phases are, how they differ from each other. The market had kind of hoped that next stage would be mini bulk sampling for grade, so you can see what the macro grade is and maybe get a better glimpse of what the macro diamonds will look like. The micro diamonds, even in this batch of results, they're generally clear and white, which is different from what they got from the Arbutus kimberlite, which is a low off the Finley kimberlite that De Beers found in the late 90s and on which it spent the most attention. But this one, when I do the tonnage footprint, it's got a maximum range of 10 to 20 million tons. Whatever the grade and chemistry is, De Beers has never disclosed that information, but clearly a 10 to 20 million ton system would not have been big enough for a standalone operation. So heading into next year, Arctic Star would like to do a program probably in a $3 million range, which delineates the Sequoia complex. And by the way, the Sequoia complex, when you look at it just in terms of your rectangular footprint, that's sort of a 50 to 60 million ton block. But if we're dealing with these tapered pipes that are coming up next to each other, we're maybe talking about a series of bodies that could collectively constitute a 20 to 30 million ton footprint. So this is a serious size, and if they can identify those that have the better grade and decent quality, and they don't need to rebuild a Caddy or Diavik processing facility from scratch, you have a potential outcome that could end up being worth $100, $200 million. But what do you do with a company that's got 212 million shares issued? 358 million of that is fully diluted, and of that, over 100 million are warrants, most of them at 10 cents. A big batch expires on March 31st of next year. But this 10 cents is pretty much the upside limit, because you can guarantee you that the owners of those warrants have long sold their long position and are just sitting on this free lunch. So I've been sort of scratching my head, how does Arctic Star, without doing another rollback and screwing all the existing shareholders like they've done 3 times in the past, and Buddy Doyle is ready to strangle Pat if he does another rollback and makes Buddy start from scratch, rebuilding his own position in the company. How do you finance this? And I think this life exemption that has just become available is potentially a path for Arctic Star to raise that $3 million that they need. Sure, you might have to do 150 million units at 2 cents with a 5-cent warrant. But if you pitch this to this retail audience and say, hey, here's the diamond story, here's the path to how to think about diamonds. And I've done a lot of work recently to make it easier for people to understand why diamonds are hard, but also what to look for when you're making your choices. Bring in this audience, get financed, and when you hit the lid, your 2-cent stock has got a 5-bagger. If the company with, say, $500 million fully diluted ends up being at 20 cents, that's a 10-bagger from the 10-cent price, and at that would be a 20 cents times 500 million. That would be $100 million valuation, and that's what future mill feed for Ekati or Diavik coming from the Hardy Lake block, which has seen no exploration since the early 2000s, and which was only explored from the perspective, is there critical mass for a De Beers caliber standalone operation? No, that old model doesn't apply. So the rethink of this whole Diagras project is, to me, probably the most exciting Canadian diamond play out there right now, with the potential to, especially if they do this life exemption, to bring in retail investors, bring in a large, hundreds and hundreds of shareholders who not only own shares but also own warrants, and get them to study this company, follow it, and spread through their various social media networks, turn this thing into a viral story that's sort of like a diamond revival exercise. When Pat started all this, he was more thinking as almost a nostalgia trip for all the old timers from the 90s. No, I think this is a platform with this new exemption to revive diamond exploration for an audience that has no clue about it, and to use the ability to fund directly the company as the key to pull them into the story.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.